Who doesn't know Rick? Raise your hand. Okay, so no introduction needed. Rick, you have failed retirement spectacularly, much to our benefit. Thank you for doing this. Thank you for being here. In case you haven't known about Rick's accolades, he was the former Spot CEO, Spot US, Rule Investment Media, founder of Battle Bank. Am I missing anything?
For the older people in the crowd, I was a proprietor of a bar on Hornby Street called Sneaky Pete's and a restaurant called Charlie Brown's. That was where I learned the investment business. Pouring whiskey for Peter Brown, asking him questions when he was drunk, writing down the answer in a 3x5 little thing, rinsing and washing and repeating. So my true genesis in business was being a bar owner here in Vancouver.
Also a boxer in his youth. We're gonna talk about risks and opportunities of 2024. I like to start by polling the audience, so I'm gonna ask you a question. Raise your hand if you feel like this applies to you. If you believe that a recession this year is your top concern for your investments, raise your hand. Interesting, very different crowd from yesterday. If you believe inflation is still a concern, raise your hands. Okay. If you believe that a Fed pivot will dramatically change your asset allocation, raise your hand. Stock market crash. Real estate crash. We're in Vancouver, so that makes sense. Rick, let's talk about inflation. I think that's what the audience wants to know. Inflation has been coming down on paper, but you and I had a conversation about it yesterday. It's actually much higher than it's reported, is it not?
Having asked the question, you're going to get a pivot. If people ask me what the greatest risk that I see, in 50 years of investing, I've learned that the biggest risk that confronts me is conveniently located to the left of my right ear and to the right of my left ear. The thing that scares me the most this year and every year is making stupid mistakes. And I would suggest that this audience, before you worry about inflation, which I'm worried about, before you worry about a recession, which I'm worried about, before you worry about the idiocy with which people vote, which I worry about, you worry about being an idiot yourself. So I would suggest I would start with that. Now, David, I'll answer your question, but I wanted to get that in. He asked me the question ahead of time, what I was worried about. And immediately what came to my mind was my own mistakes, because I'm familiar with those. Inflation. I believe that most people in the world view inflation from the prism of the CPI, the Consumer Price Index. And I think that's a big mistake. I think it's a big mistake for several reasons. The first is that the CPI is, quote, hedonistically adjusted, which means that the framers of the index decide arbitrarily the value of the computer you buy and the house you rent, irrespective of the market, which is to say that the inmates run the asylum. But that's not the worst problem. A different problem is that the CPI, when it's inconvenient, doesn't include food or fuel. Can you imagine the relevance to somebody like me of an index that doesn't include food? Silly. But that's not the worst part. Brace yourself for this, because you don't think about it. The CPI doesn't include the largest cost component of your cost of living, which is tax. Now, if I didn't have to pay the tax, I wouldn't bitch quite so much about the index. But the truth is, when I backtest the price escalation of the basket of goods and services, not that tax is actually a service, that I consume, my belief is that the purchasing power of my savings is declining at 7% compounded in US dollars, the strongest currency in the world. So when people tell me that inflation is less of a concern because it's 2.7, my response is hedonistically adjusted for people who don't drive, fly, or eat, and people who don't pay tax. For the people in this room, inflation is running at about 7% compounded. So think about this. You put money in a 10-year Canadian Treasury or 10-year US Treasury, you're getting paid 4% in a currency that's declining at 7%. That means that the 4% yield you get is costing you 3% a year. Anybody who isn't concerned about inflation is somebody who can't do arithmetic.
Thanks. Rick, stick around. Rick Rule will be revealing some of his recent purchases and investments. And I will be opening up the floor to one or two questions for Rick towards the end, so I'll save some time for that. I want to address some of the biggest concerns that have been brought to my attention throughout this conference. This is the second day. First one, is the dollar going to collapse? And I'm going to share a quote from you. What's inevitable may not always be imminent. Is a dollar collapse inevitable before we talk about the imminence?
It depends on what you measure the U.S. dollar against. The U.S. dollar, like every other currency in the world, is a floating abstraction. My friend Doug Casey famously says that the U.S. dollar is the worst currency in the world with the sole exception of every other currency. So if you measure the U.S. dollar against the euro, or I dare say the Canadian dollar, or against the yen, or against the yuan, or against the rupiah, the dollar will do well. And it will do well for 30 years. If you measure the dollar against the dollar, which is to say you measure the net present value against the value of the dollar as a brand, then you have reason to be concerned. The idea, as an example, that the dollar is going to be eclipsed by the BRICS is silly. Doug Casey again. The dollar, quote, is an IOU nothing. The euro, because there's 16 people in the constituency, is a who owes you nothing. The BRICS, given the unconvertibility of the underlying currencies and the untransparency of the nations supporting it, is a nobody owes you anything. So you do want to I owe you nothing, or do you want a nobody owes you anything? Which is to say, to quote another really famous commentator whose name escapes me, the dollar's the prettiest mare at the slaughterhouse. It'll be around in ugly form for the balance of my lifetime. For the record, I'm a fairly healthy 70-year-old.
If something were to become prettier, to use your analogy, what would that be?
I'm an old-fashioned guy. I measure my wealth in a less efficient medium of exchange, which is gold. I actually backtest my expenditures, my savings, and my net worth. I measure it in dollars too, because it's easy, but I try and maintain a golden constant so that I have the ability to frame my discussion with myself about my family's finances in gold. I love the fact that the world has a bunch of currencies, including things like Ethereum and Bitcoin. I love the fact that there's organizations around the world, given that I'm a consumer of currencies, who are trying to invent currencies that suit me better as a consumer. Right now, the most useful currency on the planet is the US dollar. I suspect that the most stable currency on the planet is gold.
Okay. We won't come back to gold. I want to ask you about the economy now. The M2 money supply, as you're aware, has been in decline. It has never been in decline since the Great Depression. It's always been in constant growth, maybe a few percentages, but never in negative growth territory. What does this mean for economic growth?
I'm impressed that the Fed has had the courage to shrink the balance sheet. I'm impressed, too, with the stability and the durability, particularly of the U.S. economy. I would have expected, with nominal interest rates rising as rapidly as they have, that the destruction of the economy, that the destruction in spending around consumer durables would have been much more severe than it has been. I live in a little community in Washington that's experiencing a genuine labor shortage, a place where somebody who applies to Safeway to learn to be a checker gets paid $20 an hour. This is a surprisingly durable economy. I'm delighted that the nervousness that I had 4 years ago turned out to be ill-founded. Because I'm old enough, remember the decade of the 70s. And in the decade of the 70s, all the writing was on the wall for the debasement of the currency. Those of you who are old enough, all 7 of you, will remember at the beginning of the decade of the 70s that the U.S. government fought the war on poverty. We fought the war on drugs. We lost both, by the way. And the consequence of which is that our debt, including off-balance sheet obligations, was greater than our ability to afford it. The way we dealt with that is we inflated away the net present value of the obligations. My fear is that the impact of higher interest rates and reduced liquidity via the M2, that the punch has been felt, but it has a delayed impact. In other words, my nervousness, and by the way, I'm no economist, David, as you know, my nervousness is that just because we haven't felt the impact of it yet, it doesn't mean that the impact won't follow. But I have to say I'm delighted to have been as wrong as I have been for as long as I have been wrong on that.
Well, are you concerned about a liquidity crunch leading to a credit event like 2008?
Scared S-less. There's too much complacency in the economy. Black swans are by definition black swans. You don't know where they're going to come from. And I would suspect that a lot of the strength, at least in the markets, particularly the bond market, which is completely illogical to me, has to do with too much complacency. I remember my own actions leading up to 2008. I remember very well driving up the 405 freeway in Los Angeles, northbound, and there was a big billboard on the right. It said, borrow 125% of the value of your home. Bad credit, okay. And I remember thinking, I'm not a real estate guy, but I am a lender, and that doesn't sound very cool to me. Now, if I was a logical, rational human being, I would have started selling stuff with my phone the second I saw that call, but I was complacent. Your expectation of the future is set by your experience in the immediate past. And I am terrified, literally terrified, about the prospect of a liquidity squeeze. The consequence of that is, despite the fact that I'm receiving negative real interest rates on cash savings, I have a lot of cash savings. I believe that the negative real interest rate that I suffer is an option payment on having liquidity so that I can take advantage of a market crash rather than being taken advantage of. My special fear, since we're talking about fears, is high yield or junk debt, corporate debt. In the US, and they probably have them in Canada too, I'm just not a victim of this up here, they have several $1 trillion in ETFs that are junk bond ETFs. The, sort of $5,000, $10,000, $15,000 investors, we so inelegantly call them the yield whores, have decided to buy these high yield ETFs because the topco, the ETF itself, is so liquid. But the ETF owns a whole bunch of illiquid securities that comprise this liquid cover. If you had the beginnings of a credit contraction like we had in real estate in 2008, and the junk debt market started to sell off, and people began to redeem their ETFs, the ETF manager will sell the most liquid holdings they have first. In other words, their best debt goes first. And then they get stuck with stuff that's both lousy and illiquid. There was a phenomenon back in the junk bond days, the Drexel-Burnham days, of an owl bond. Anybody in the room know what an owl bond is? An owl bond is when you call your broker and say, sell, and he or she says, to who? To who? And my real terror is that there's a run on the bank with high yield ETFs, with no federal government necessarily able to bail them out. If you want to ask me what keeps me awake at night, that's what it is. And because I've identified it, it probably won't occur.
You don't seem like somebody who has sleeping problems, Rick.
I don't. I have a lot of cash and I have a lot of gold. And for a 70-year-old, I sleep pretty well. That's a big caveat.
I want to gauge sentiment one more time before we close off on your investments. Sentiment on the economy from the audience. Who here is concerned about layoffs in 2024? Not a lot, okay. Who here is still spending discretionary income on shopping and going out, restaurants, so on and so forth? Raise your hands. Don't be shy. Okay, you see, we're talking about a recession, but actually unemployment rate is still low. Consumer sentiment seems to be reasonably strong. Not everyone's concerned about losing their jobs in the job market this year. I
think one of the things that folks like me get wrong By the way, in terms of my economic forecasting track record, I have absolutely perfectly called 17 of the last 3 declines. I have an infallible record, so I'm always afraid. 2 comments there. There are a lot of people who don't seem to have any money. It isn't because they don't make any, it's because they don't save any. They think that a $600 purse or a $4 cup of coffee will make them happy. That's horseshit. You're happy or you're not happy. And the idea that you're going to be successful in your declining years, or at least solvent in your declining years, requires this weird habit called saving. If you don't have money working for you while you're sleeping, you are never going to be solvent. The way you become a capitalist is it requires having some capital. And that requires saving. So it's interesting, the question you asked.
Let's close off on wealth preservation tools. Tell us about some of the recent investments you've made and how you aim to preserve your wealth. I know that's a 2-part question, but let's link it together.
Well, let's start with the one that nobody wants to hear. Cash. I have a lot of cash. And I have cash despite the fact that my interest rate doesn't compensate me for the rate of inflation as I see it. I have it because cash helps me sleep night and it gives me the advantage. But that's not the answer you're looking for. The stuff that I've bought, I continue to buy the oil industry. Why do I do it? Because it's cheap. The big thinkers of the world, that noted energy physicist, what's her name, Greta Thunberg, my president, your prime minister, tell us that demand for oil will peak in 2030. Now, they don't have to worry about whether their car will start or not because you pay for their gas. But I believe that peak energy demand takes place in 2065. I know that the oil industry is underinvesting $1 billion a day in sustaining capital investments, which will impair the industry's ability to produce in 2 years, which is to say that production shortages will continue to be exacerbated. So I like the oil and gas industry. Are there names? Yeah. If you're American, you start with the best, Exxon. It's amazing that people look at Exxon and they look at the enterprise value relative to free cash flow generation and they don't buy the hell out of it. It's stupid, but okay. If you want to take a little more risk, or if you're, proudly bearing a maple leaf, if you can take a little more risk, the circumstance is much better up here. You have this guy at the top who, through his idiocy, is making the oil industry better and better and better. That's this guy named Trudeau. He's the best promoter we ever had, constraining supply, keeping margins high. Do these companies have names? Best managed mid-cap oil company in North America, ARC, Canadian company. Freehold royalties, boring company. I love to be bored. It's the antidote to terror. Tourmaline, Peyto, Birchcliff. Wonderful group of companies. Cheap. Pay you a great dividend. So we start with oil. Probably nobody's going to take advantage of that here because they don't want sensible recommendations. They want nonsensical recommendations. So let's get into that. I like great big deposits, and I like great big deposits that everybody hates. Lots of them out there. Centaurus, Australian listed. Big deposit, not in production yet. Platinum, palladium, nickel. 3 commodities that have fallen in price precipitously. So the price of this company has fallen precipitously. $10 billion plus in situ recoverable reserves and resources. I love it. Sovereign, largest rutile deposit, second largest graphite deposit in the world, in a country called Malawi, which most people can't spell. So they won't buy it. I love it. Meteoric, also in Brazil. Really important rare earths discovery. Ginormous deposit, average in situ grade 3 times as high a grade as the average producing rare earths deposit on the planet. If you want something a little closer to home, a Canadian listing called Reunion, exploring a very large deposit in another country that most people can't spell, Guyana. You'll hear me say this afternoon, by the way, you've probably heard me say I love hate. I like asset categories that other people don't like, precisely because they don't like them. Uranium treated me well. Unfortunately, people like uranium now, so I have to begin to take my leave. What people don't like is risk. What people don't like anymore is the sub 10 million market cap space. The four-letter word now in investment is exploration. I've been priced out of the exploration business for 12 years because the private placement terms favored the companies rather than the check writer, and I'm a check writer. But in the last 8 weeks, that's changed. So I'm going to come back into the exploration space myself in spades, precisely because everybody hates it.
Let's have one question from the audience. The question was comparing 2016 to now.
I liked 2016 in the sense that we were 4 years into a bear market. What's better now is that then there was still hope around the juniors. People have truly thrown the speculative stocks out with the bathwater. There has been a hiatus in purchasing of the juniors now that's gone on for 12 years. And the market forgets that the juniors can go up in price. So for me, I mean, for the issuers, this is worse than 2016. Because it's worse now for the issuers, it's better for the check writers, and I'm a check writer. So I like this market better than that market.
Thank you very much, Rick. I really appreciate your time. Thank you for being here. Thank you for attending.